Hey, welcome back to Lunch at the Market. We appreciate all the comments on the YouTube channel for the last episode of Lunch at the Market, and so today we're going to answer some of those questions. The first topic for discussion is directional bets with options. We had a viewer write in about buying Bank of America puts. Okay, we don't like naked directional bets on options because chances are you're going to be wrong, especially if you buy out of the money options. Okay, remember to make money, an out of the money option has to become in the money by expiration, and usually that doesn't happen unless the stock moves huge. Okay, the other thing, something like a WikiLeaks, right? When that event is actually known, meaning they actually release the information they say they have, it's called buy the rumor and sell the news. The market already assumes to some degree what the event will be and prices that into the market ahead of time. In the instance of Bank of America, the stock got absolutely hammered at the first hint that WikiLeaks had this kind of news, which means that when the actual news is really released, it's going to be a non-event, or it'll be the opposite of what you think will happen. So if you think the news is going to be horrible, they report it, and it's not horrible, then that means that the stock is actually going to trade up. Okay? So you want to make sure that when you're making directional bets with options, that you give yourself time to be right. We don't like being long front month options unless they're protected. Okay? So avoid making naked directional bets with options if you can, and you'll save yourself a lot of money. If you're wrong in your long, you lose 100%. Okay, now what we did do is buy Bank of America 12 strike puts for February for insurance. So Geico insures your car. Most people can't insure their car for a total loss on themselves, meaning if you get in a car accident and it's a total loss, somebody completely wrecks your car, most people can't afford to just go out and buy a new car. If you can't, then you go buy insurance because that's exactly what the insurance will do. So somebody, if the market crashes into our Bank of America stock and totally ruins it, then we will make a claim on our insurance by exercising the put and making some other joker take it for 12 bucks. So if Bank of America goes to 8, we'll exercise the put and make them take it at 12 bucks, even though the market's only trading for 8. Then if we want, we can go out and buy Bank of America on the open market at 8, or just say, you know what, that position didn't work out, we lost a buck, but it sure heck could have been a whole lot worse, right? So that's why you have puts. You don't buy naked puts in the hopes that something goes down. If you think something's going to go down, short the stock or the option or the short the stock or the ETF, and then buy a call against it as your hedge. Then your max loss is limited to the cost that you paid to put on the long call. Does that make sense? Okay, if you think Bank of America is going to go down, short it here, sell it short here, and then go out and buy a 13 strike call. Then, if Bank of America goes up, you just strike called away at 13 bucks. You lost the money you paid for the call, and then you move on with life. If Bank of America goes down, you're protected. Okay, so you can stay short the stock until you feel like the move is over, and then you can cover. Um, but when it comes to shorting things, you probably want to short, if you're going to be hedged, you want to short bigger stocks. Um, Stocks like a Netflix or Chipotle Mexican Grill or NTAP or something like that that moves a whole bunch all over the place. Then paying a buck for a call as a hedge is not really a big deal. Okay? All right. So we got Bank of America, naked directional bets, WikiLeaks. Oh, so we talked about buying the rumor, selling the news, directional bets. If you want to make a directional bet, we prefer you do it on the entire index. It's actually easier to kind of tell where the broad market will go as opposed to individual stocks that are going to react on individual stock news. So for a directional bet, we like the VIX and the SPY. The VIX, you can buy a call spread. Brian Stutland from Stutland Equities on last Thursday's Fast Money Final Call told you about the 1821 call spread in the VIX. We actually like that, but when the VIX spiked up today on the open, we couldn't get the price that we wanted for the call spread. So we've got a limit order sitting out there. Hopefully we get it. Then that will protect you against the overall a declining overall market. The VIX usually goes up when the stock market goes down. They work opposite of each other. For more on volatility, see our video on our YouTube channel called Explaining Volatility. Okay, so just type in MO financial and volatility, and you'll find our video. If you see a video with a blender, that's the right one. All right. The other way that we like to hedge ourselves or make directional bets is the SPY. We're long a 125, 120 put spread in SPY. The SPY is the tracking ETF for the S&P 500 index. Okay, we're long the put spread. We make money when the S&P declines below 125 or the SPY goes below 125, and we stop making money at 120. Okay, that long put spread is how we protect our long portfolio. Okay, so as the market goes down and our positions lose money, this will be in the money and we can sell it at a gain. The max profit is the full $5 between the two strikes. And we only paid about $1.47. So for $147 per spread, you can protect yourself to the downside using the SPY. Okay, some of our trades that we did today, we shorted, surprise, the Netflix 160, 155 put spread. So we're short at 160, we're long at 155, and we did the same thing in Cree, where we shorted the 60 and got long the 55. So we're short put spreads in Cree at 65.55, and we're short put spreads in Netflix and FLX 160, 155. Now, another viewer asked about CLF 80 calls. First of all, CLF 80 calls in April are out of the money, and we don't like doing out of the money because you're just gambling. It's just speculation. Okay, we'd rather see you do something in the money and make an investment, especially if you're going to be out on a time horizon like April. So consider the 65, 65, 75, 80 call spread risk reversal in CLF. It's just a long call spread, 65, 75, and then short a put against it. You're a net seller of options, so you can actually put it on for a 20-cent credit. That makes the trade an instant winner, meaning as soon as you hit the button, you've already made money on the trade. Your max gain, of course, is the $5 between the two spreads. So your trade that you took in 20 cents could actually be worth $5. So you're going to go from making 20 bucks to making 520 bucks if CLF is above 80 by April expiration. If nothing happens, then no big deal. You took in 20 cents for the trade, you wasted a few months, but hopefully this isn't your whole portfolio, because if it is, then you're not diversified. So you should be able to wait for some of these trades to actually work in your favor. Okay? If the stock finishes anywhere in between 75 and 80, then you're going to have some intrinsic value to your call spread. Again, you'll turn a 20-cent credit into, say, a $1 credit, which again is a huge rate of return on a percentage basis. Okay? Considering you actually got paid to make the trade, and your downside doesn't start until $65. Actually, $64.80, but we won't get into the math on that. Okay, so try to avoid naked directional bets using options. Try to stay in the money and not out of the money. The only time you want to use out of the money options is when you hedge, like buying a put below where the stock trades or selling a call above where the stock trades. No cost collar. No cost collar and protected put. That was the episode from last Thursday's Lunch of the Market. So check that out if you have additional questions. As always, you can leave comments on this video or in our comments section on the channel, and we'll always get back to you. Hope this helps. Thanks again for tuning in today, and have a great day. We'll see you tomorrow.